Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. Okay, dear students, our today's topic is capital asset pricing model, which is also called CAPM. And before to explain the definition of the CAPM, let me show you what the CAPM is and how does it look like, right? Okay, come here. Dear students, this equation, what you see it here, or this formula, Rj is equal to Rf plus beta into Rm minus Rf, this equation is called CAPM, in simple CAPM, or capital asset price model. So wherever you see this in books, in internet, or anywhere else, this model, what we call it in simple word, a CAPM model. Okay, what does this model do for us, right? And where we can use this model in finance or in investment or in your field. Okay, let me explain. This model here in this definition is telling us the CAPM is a model. It is an equation, what you have seen, that describes the relationship between risk and return. Wow, so easy. It means this model, right, is showing you the relationship or measuring you the relationship between two things. What are them? Risk and return. Okay, if you want to make investment in a company, and that is MTN company, right here. Okay, you want to make investment here, so automatically two things come in your mind, right? What are them? Risk and return. One is risk and another is return. Okay, if you want to make investment here, then you are expecting some return, right? Okay, so if this company or MTN company, right, if this company is having a risk, here is a risk, then you have to expect return according to the risk. According to what? Risk. And this is called the trade-off. It's called what? Trade-off. Mean there must be a balance between risk and return. So if the risk is higher, the return should also be higher, and if the risk is lower, the return should also be lower. And this balance, what we try to expect, is called the trade-off between risk and return. Okay, so dear students, this model is helping us. This can help us to measure how much the risk this company has, and on the basis of this risk, how much return I have to expect from this company. So you should not be mistaken. If the company has higher risk and there is a lower return, you should not make investment. And if the company is having higher return for same level of risk or a lower risk, then you should invest in that company. Okay, what can help you in that decision? This model, right? Okay, let me explain it further now. Assume there are three opportunities for you, right? This is one opportunity. Okay, this is another opportunity, and this is a third opportunity we have. Okay, right. The first opportunity is the government, right? You can make investment in the government. The second opportunity is you can say general market, right? We can also call it the market portfolio. And the third opportunity you want to check, right, to make investment in is the company. Which company? MTN company. Okay, so you can make investment here, you can make it here, and also in MTN company. Now you don't know where to make investment. Okay, so keep in mind, if you want to make investment in anywhere here, then we are concerned with two things. One is risk and another is return. Okay, the government is telling you that if you want to make investment here, we are giving you 4% return. How much? 4% return. And this 4% return is called RF, risk-free return. Okay, why? Because if you want to make investment here in the central bank of the country, in the treasury bill, or in Afghanistan situation, in the capital note, then in this security there is no risk. We call it risk-free security. You can get 4% without any risk. You know the reason why? Because the government, whenever the government is not having any notes, and if the government default, because I have told you that even if the government default, then the government can print notes, right? Okay, the second opportunity we have is general market. And if you want to make investment here, this is what we call it, a market portfolio, or this assume this is the stock exchange market where you want to make investment. So the stock exchange market by average is giving you return how much? Also 4%. Why? Because this market or general market is competing with the central bank, is giving you 4% return also. But keep in mind, the general market is telling you that we are giving you 2% extra. How much? 2% extra, meaning 4% plus 2%. The reason behind why? The reason is because the general market is telling you that we are not like a government. We have some sort of risk. Mean in this general market there is a risk. Okay, return on the market in whole we have is 4% plus 2%, the 2% extra because of the risk, right? So in total, the general market or RM, return on market, is equal to 6%. Keep in mind, dear students, this 2%, right, this is also called risk premium. Okay, okay, this is called risk premium. Okay, what we mean by a risk premium? Reward for risk. This 2% is only reward. This is a premium because here is a risk. That is why the general market is giving you 2% extra, while here is no risk, so the company is only giving you 4%. The government is giving you how much? 4%. Okay, this 2% is called risk premium, and it can also be computed such like, it's mean is equal to 6% minus 4%, mean this 2%. And this risk premium is in exchange for what? In exchange for the risk the general market is having. We have another opportunity, and that is MTN. That is a company where you would like to make investment. Okay, if you want to make investment in the MTN company, MTN is telling you we are also giving you 4%. Why? Because we are not less in the general market, in the government. Why? Because we are giving you also 4% return, right? Because competing here in the market. But the MTN is telling you we are giving you here the risk premium higher than the general market. Why? Because the MTN or this individual company is telling that the risk is even more higher from here, right? Okay, how much higher? 50%. Assume MTN is telling that the risk we have is 50% higher than the general market. Okay, so if for the risk the general market is giving 2% return, and if the risk in the MTN company is higher from here by 50%, so the return should also be higher by 50%. right? This is a trade-off. If the risk is higher from here 50%, so return should also be higher 50%, right? It means we should make this 2% 50% higher here, right? Because the risk premium should be according to the higher risk. Okay, so if the risk is 50% higher in MTN, it means the 2%, if you increase it by 50%, is equal to how much? 3%. Why? It's so much easy. How? Because the 50% of 2% is equal to 1%, and when you add it back into 2, that is equal to 3%, right? So in simple word, dear students, if you want to make investment in MTN company, the MTN is telling you, come on, we are giving you 4 plus 3. So in total, the company is giving you what we call it RJ here. In some books, it is also KE. It is denoted by KE. So in total, you can say 7% is given, should be given, right, by the MTN company. Why? Because whenever you make investment here in this company, this return should be based on the risk. So if in this company the risk from the general market is higher, right, so the return should also be higher. So you can say now the MTN is giving the return according to the systematic risk the company has. Okay, dear students, this is what you have learned about. So this function or formula is exactly computing this 7%, right? It is not a magic. I'm just making it simple for you here. Okay, how it works, look here. So RJ, that is return on stock J, right, which is MTN in our example, right? And then we have RF, this is our risk free return. Then we have beta, this is showing systematic risk. I explained it what we mean by. And then we have RM, this is called return on the market or on market portfolio, Okay, dear students, just pay attention a little bit here. We try to put all the data we have here in this equation. Okay, so in the equation RF is given, and that is how much? 4%, right? And also the RM is given, and that is 6% we have in total, right? And RM minus RF also we have is 2%, but we don't know what is beta, right? The BJ, which is called the beta or the beta, in American English is called beta, in British beta. Okay, so what is this beta? Okay, this beta is showing the rate of change. It means the 3% which is changed from here, by which rate it changed, right? What does this mean? Assume we have a 2%. I told you we have increased the 2% by how much? By 50%. Increase it by 50%. So this is increase. We call it increase. Means 2%. This is our risk premium. Okay. Increase the risk by how much? 50%. Then how much will be the risk premium, right? Premium given by MTN, right? Or by stock J here. So much easy. If you increase 2% by 50% is equal to 3%, right? It's equal to how much? 3%. And if you want to know how much is the rate of change here, how this 3% is computed, so much easy. Look here, it is actually like this: 2%, right, into multiply this by 1 plus 50%, right? 2% is equal to 1 plus 50%. So it's mean if you multiply 2 with 1 plus 50% is equal to 3%, right? You can also write it like 2% into 1.5. Why? Because of 50 divided by 100 into 1 is equal to 1.5. So you can say whenever we increase the 2% by 50%, it will become 3%. So how much is the rate of change here? You can say 1.5. This 1.5 is called the rate of change, and this is called the beta, right? 1.5. What does this 1.5 mean here? Okay, let me make it simple number. This is only a number 1.5. okay, this is called the beta, or the rate of change. It's mean this return 3%, which is increased by how much? By 1.5 rate. 50% means by 1.5. So in simple, the beta is showing the systematic risk, mean how much is the risk in the MTN company. You can say 50% higher than the general market. If it is 1.5 means 50% higher. If it is 1.1 means 10% higher. If it is 1, it means the risk in the general market in the MTN company is same. The risk is what? Same. Okay, so now we put all the information in this equation and we will get how much is our required return. So RJ, this is equal to RF, right? How much is RF? 4% plus how much is beta? That is 1.5. okay, and then how much is RM? Okay, RM is 6% minus how much is RF? 4%, and this is equal to exactly 7%. I hope you got it. Now we found how much is RJ? That is 7%, and this is called the required return. What is the interpretation of this 7%? This means if you want to make investment in the company MTN, the MTN company, then on the basis of the risk, how much is the risk here? 1.5 means 50% higher than the general market. Then how much you expect from this company? 7% in total. How much? Okay, we found the answer. Mean if the company, or if this company is not giving you 7% return, it's mean the return is not based on the risk. So now it is leveled up, right? So this return is called the minimum expected return by a shareholder. So in other words, this is called the required return for shareholder, and also it is a cost for a company. Why? Because the company is paying it against the financing reason from shareholders, and the investors receiving 7%. So you can say this is a return for them. I hope you got it and what we mean by this formula. Keep in mind, my dear, this RF and RM and the beta must be given, right? If it is not given, then you cannot find out how much is RJ. So the beta and the RM, that can be found in the website, and you can go into the company and find out how much is the beta or the systematic risk of the company. I hope it is clear. Wish you good luck. If you have any questions, you can ask me in the group.